In our last class, we discussed, we stopped at project-specific cost of capital, and I provided you with the procedures involved in determining or in calculating project-specific cost of capital. Specifically, I mentioned to you that there are 5 procedures you are going to undertake whenever you want to calculate project-specific cost of capital. Before then, uh, we discussed that project-specific cost of capital is computed when a company is diversifying into a new industry or when debt equity proportion are expected to change significantly as a result of undertaking a project. Therefore, there will be need to estimate a cost of capital that will be consistent with the risk associated with the project. This is because the existing cost of capital of the company will not be suitable to appraise a project in the new industry where that company is moving to. Therefore, it is important for the company to estimate a new cost of capital that will incorporate the risk in that industry and also the financial risk that's that is associated with the project. And that is essence of calculating project-specific cost of capital. And we said that for calculating project-specific cost of capital, there are 5 procedures. Number 1 procedure is to identify the proxy beta, that is the beta of the companies that are already operating in the industry where the company is moving to. Therefore, we are going to borrow the beta for the purpose of estimating that appropriate cost of capital that will be suitable for the company to appraise its project. Then step 2 is to ungear the beta if it is geared. And we said that ungeared beta is the same thing as asset beta. And asset beta measures only business risk. All right. Then after that, we said that you are only going to undertake step 2. You are only going to calculate asset beta if and only if the proxy beta that have been identified in step 1 is geared. Then how would you know that the proxy beta is geared? We said that when the proxy company has debt in its capital structure, it means that the debt beta identified in step 1 is a gear beta. So if it's a gear beta, then you need to go and ungear it to remove financial risk. Then thereafter, we now say step 3 is to estimate, is to regear the beta in order to incorporate financial risk of the main company. So I provided the formulas for ungearing and regearing and all of that. Then in step 4, we said that we need to calculate cost of equity using capital as a pricing model. All right. Then step 5 is to calculate weighted average cost of capital. So those are the things we did last time under project specific cost of capital. Today, what we are going to do is to have illustration. Then after that, we move to the weighted average cost of capital of the combined activity. Let me share my notes with you, and so that I can briefly show you what we did in our last class. Okay. Yes. Let me know if you can see my screen. Can you?
Screen.
All right then. Thank you.
Yes.
Okay. Yes, like I mentioned, this is what I just re-emphasize again. Last time I defined for you what proxy company is all about. Then we talk about business risk, financial risk. Then we define what is beta. And I've said that there are 2 types of beta, asset beta and also equity beta. Then I now provided the procedures for calculating project-specific cost of capital. So these are the things I just mentioned to you. So today, like I said earlier on, so we are going to have illustration straight without wasting time. Okay, I will build on this note. All right then. So everybody, please, I need you to open to the material I just shared with you, and let's have a look together. And okay, go and pick the material, and then please, I need you to bring um just put by your side the calculator. I need everybody to participate. When I ask for you to give me numbers from your calculator, please do so as immediate as possible. And at the same time, when you unmute yourself to give me number immediately, please, once you are done, mute yourself again so that we don't distract the class with background noise. All right. Thank you, guys. So can you see my screen on Kilimanjaro?
We can see your screen, sir.
Okay, then. Fantastic. All right. So we are going to be solving illustration number 15. Like I said, go to the group and pick the material I just updated a few minutes ago. So it just occurred to me that let's solve this particular question. Then when we get to capital budgeting, we are going to solve the question on Ferrari that was included in the previous material I shared with you. All right then. So Kilimanjaro produces domestic electric heaters. The company is considering diversifying into the production of freezer. So as a student, once I'm reading this and I can see diversifying, I need to underline that. Because once I see diversifying, something should tell me that, oh, it is possible this question may be project specific, because that diversifying is a core, it's a calling for me to know that, oh, this question may relate to project specific. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. We are given information on Mississippi, Limpopo, Zambezi, Nile, and then Kilimanjaro. The power value per ordinary share is 25 kobo for Mississippi and Zambezi, 50 kobo for Nile, and 1 naira for Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold bill rate, which is currently 9% per year. Corporate taxes are payable at the rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its journey to change significantly if the company diversifies into the production of freezer. You are required to, 1, estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. Okay. 2, corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. 3, discuss whether systematic risk is the only risk that Kilimanjaro's shareholders should be concerned with. So this is the question. Again, whenever you are given a question, before you start reading from the body, go straight to the requirements, because the requirement will prepare your mind on the expectation of the examiner. In this question, examiner wants us to estimate discount rates that Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. All right then, so we want to calculate cost of capital. What kind of cost of capital do I want to calculate? Remember, in our previous classes, I mentioned to you that there are 3 categories of cost of capital. We have traditional weighted average cost of capital. We have project-specific cost of capital. We also have work of the combined activities. We said that if in the question you are given capital structural information like ordinary share capital, preference share capital, debt capital, then the return on those capital like dividends, ordinary dividend, preference dividend, share price, all those kind of information, then you need nobody to tell you that you are supposed to calculate traditional weighted average cost of capital. And I said last week that specifically project-specific cost of capital is calculated when a company is diversifying into a new industry. You will see from this question that from the first paragraph, examiner has told you that Kilimanjaro PLC produces domestic electric heaters. What this company does is the production of domestic electric heaters. You are now told further that the company is considering diversifying into the production of freezer. Now, this company, Kilimanjaro, wants to add to the portfolio of its products the production of a freezer. So since the company is diversifying and you are told in this question to calculate discount rates, it means that you are supposed to calculate project-specific cost of capital. Now that we know what we want to calculate, then the next thing we want to do is to go ahead and solve the question following the 5 procedures that I mentioned in calculating project-specific cost of capital. So let's do it together. I will stop sharing this material, then I will switch to the new, to working notes. Let me know if you can see my working notes.
Very clear, sir.
All right then. So let's solve the question. Let me move to the next page. Okay. The name of this company is Kilimanjaro. Roman figure 1. We have to calculate discount rates. I would then say calculating discount rates. If you like, you call it discount rate, or if you like, you call it cost of capital. It's the same. So this is what examiner wants us to calculate. At this point, I need to ask myself, what kind of discount rates? Is it project specific? Is it traditional weighted average cost of capital? Is it work of the combined activity? We have identified from the question that Kilimanjaro is diversifying into the production of freezers. Therefore, the first procedures you are going to carry out when you want to calculate project-specific cost of capital is to identify the proxy beta. Step 1, identify. Please, on the day of your exam, let me show you exam method. There's no need for you to say identify the proxy beta. You already know that what you want to do is to go to the question and pick the proxy beta. So just come here and say proxy beta. I will then go to the question. In this question, go to the material place. In this question, there are 4 different proxy companies. We have Mississippi, Limpopo, Zambezi, and Nile. Those are the 4 companies that are into the production of freezer in the freezer industry. So I need to go and pick the beta of Mississippi, Limpopo, Zambezi, and Nile. When you look at the last line in the table, you will see beta equity. You see beta equity, 1.1 for Mississippi, 1.25 for Limpopo, 1.3 for Zambezi, 1.05 for Nile. So we need to add all the beta equity together, then you divide it by 4 to get the average beta. So we are going to add the beta of Mississippi plus the beta of Limpopo plus that of Zambezi, and then the Nile. Because we added 4 variables together, we are going to divide it by 4 to get the average. Therefore, the beta of the proxy will be equal to, for Mississippi, we have 1.1. Here is 1.10 plus 1.25 plus Zambezi is 1.3, then 1.05. 1.3 plus 1.05 divided by 4. Please, on the day of your exam, no need for you to be doing this. Just carry your calculator, add it together, find the average. Okay? So there is no need for you to be doing the working, that you don't have time. You don't have all the luxury of time on that day. So 1.1 plus 1.25 plus, is it 1.4 or 1.3? No, 1.3. This one should be 1.3, not 1.4. Let me confirm. Yeah, 1.3. Okay. Plus 1.3, then plus 1.05 equal, then divide by 4 equal 1.175, approximately 1.18. So we have identified the proxy beta, and the average beta for the 4 freezer companies is 1.18. Then that will take us to step 2. In step 2, we are supposed to ungear the 1.18 only if the 1.18 beta is geared. So we then go to the balance sheets of the proxy company to go and identify, to go and check if the proxy company has debt in its capital structure. If you go to the material in the balance sheet under finance by, you will see that the 4 freezer companies has bank loan in its capital structure, in their capital structure. It means that the beta of 1.18, the average beta of 1.18 is geared. So since the beta is geared, we need to ungear it. Therefore, I would then say ungear. You ungear in order to remove the financial risk. Hello?
Yeah.
Your line is breaking. I can barely hear you.
Can you take the explanation again? Sorry. Can you take the explanation?
Okay. This is what I'm saying. In step 1, we have identified the proxy beta for all the 4 freezer companies. The average beta is 1.18. So we are going to step 2. You will only ungear the beta if the 1.18 is geared. How would you know that the 1.18 is geared? You will go to the balance sheets, the capital structure of the 4 freezer companies. Go to their balance sheet under the finance by. If you can see anything like debt like bond, debenture, loan note, or even bank loan. So in this question, all the 4 freezer companies have bank loan in their capital structure. So it means that the 1.18 is geared. So if the 1.18 is geared, we need to ungear it in order to remove financial risk. Is that clear?
Yes, sir.
All right. So let's ungear now. We want to ungear. To ungear, I provided two different formulas. I said if in the question you are told that debt beta is risk-free. So if we assume that debt beta is risk-free, then you are going to use the smaller formula. But if in the question you are given debt beta, it means that you are supposed to use the extended or expanded formula. In this question, we don't have debt beta in the question. Therefore, it is implied that debt beta is risk-free. So for me to get the asset, to calculate my asset beta, I would then say beta assets equal to beta equity geared multiplied by equity value divided by equity value plus debt value 1 minus tax. So this is the formula for calculating asset beta, where debt beta is assumed to be risk-free. Therefore, my BA, beta asset, is what I want to calculate. Remember, asset beta is the same thing as ungeared beta, which measures only business risk. So we want to measure the risk that is associated with freezer industry. To do that, we are supposed to calculate asset beta. And that is why, because you want to calculate business risk, so that's why we are removing the financial risk, because our focus is to get the business risk only. And that's why we are removing the financial risk, because the 1.18 included financial risk, because there's bank loan. And that's what we're trying to do, to remove that financial risk. So at this point, I would then say beta equity of a gear company, which is 1.18. Here is 1.18 multiplied by equity value. I need equity value. Maybe I should go to the next line. Okay. Beta assets equal to 1.18 multiplied by, I need equity value of the proxy company. For step 1 and step 2, we are going to need the information of the proxy companies, not the information of Kilimanjaro, which is the main company. That is, the equity value, the debt value, and the tax rates of the proxy company are what we are going to use in step 1 and 2. But from step 2 up to step 5, you are supposed to use the information of the main company, which is Kilimanjaro. So at this point, I need to go and calculate. I need to go and identify from the question if I'm given equity value as well as the debt value of the proxy company. So together, let's go to the question, please. Okay, so the market value is now given. The market value of the proxy company is not given, so we have responsibility to go ahead and do workings to get the market values. We need to go and calculate the market value of the proxy company based on the information given to us. So quickly, how are we going to calculate the market value? Let me see. This one will be for, okay. Let's start from here. Let me give additional page. Let's go to page 4. Now, working will start from here. We want to calculate market value. Working number 1. Market value. How are we going to calculate our market value? Remember, during the traditional weighted average cost of capital, I demonstrated for you how to calculate your market value. I said that market value of equity is calculated as number of shares multiplied by XDIV share price. And I also said that if share price is not given, if number of shares is not given to you, then number of shares can be calculated as share capital divided by nominal price. Okay? Not only that, I also provided the third formula that if in the question you are not given share price, but if you are given earning per share and also price earning ratio, then share price is equal to price earning ratio multiplied by earning per share. So according to this question, we want to calculate market value of equity. Let's go back to the balance sheet. If we are given number of shares, in the balance sheet of this company, we are only given ordinary shares. We are not given number of shares, so we are given share capital. 4 million for Mississippi, 9 million for Limpopo, 3.5 million for Zambezi, then 5.3 million for Nile. Those are share capitals of the proxy companies. So we need to convert those share capitals to number of shares. How do you convert share capital to number of shares? Share capital divided by nominal price will give you a number of shares. Then we now multiply with the ex-div share price. Okay? So I will then say my formula to get the market value of equity will then be share capital divided by nominal price multiplied by market price per share or ex-div share price multiplied by market price per share, or you call it ex-div share price. In this question, examiner did not give to us market price per share or share price. We are not given share price, but we have information in the question that will enable us to calculate the share price. In this question, I can see any per share. I can see any price, any ratio. I don't have current market value per share or share price. I'm not given share price in this question. Therefore, for me to get share price any ratio multiplied by any per share will give me share price. Therefore, I need to go and rewrite my formula. To get my market price per share, I would then say that is price any ratio multiplied by any per share. Okay? This is how the reason why we are calculating the market price per share is because, hello?
We can hear you, sir.
Who is talking? All right. So the reason why we are using this formula is, you remember I gave it to you when I was doing a traditional weighted average cost of capital. In financial statement analysis, when you want to calculate price earning ratio, you say PE ratio, please mute yourself. PE ratio equal to share price divided by any per share. This share price is the same thing as market price per share. It's the same thing as ex-div share price. It's the same thing as, my current market value per share. Now, since in this question, I don't have share price is not given to me. What I need to do from this formula is to just cross multiply. And that is why price earning ratio is multiplied with any per share. All right. Now, I need to go ahead and solve for each of them. Therefore, I will come in and put naira sign. I will say Mississippi is denoted as N. I will then go to the question for Mississippi. What is the share capital of Mississippi? The share capital of Mississippi is 4,000. It's 4,000 naira. That is 4 million. I would then say 4,000. Figures are in thousands. 4,000 divided by nominal price per share. Go back to the question. What's the nominal price of Mississippi? We are told that the par value of ordinary share is 25 kobo for Mississippi and Zambezi. 25 kobo is the nominal price. Here is 25 kobo, 0.25 multiplied by, I don't have the market price per share, so I need to work it out. To get the market price per share, I need to multiply price earning ratio with any per share of Mississippi. Go back to the question. Price earning ratio of Mississippi is 12. Any per share of Mississippi is 25 kobo. So I need to multiply together. 12 multiplied by 20.25. Here is 12 multiplied by 0.25. What do you get? 12 multiplied by 0.25. We have 3.
Size 3.
We got 3. So 3, I would then say 4,000 divided by 0.25 equal multiplied by 3, 48,000. Therefore, the market value of equity of Mississippi is 48,000. Next item will be Limpopo, L, equal. Again, I will go to the balance sheet of Limpopo. What is the share capital? The share capital of Limpopo is 9,000 naira. Okay, then the nominal price of Limpopo share, we are told that 50 kobo for 9 and 1 naira for Limpopo. So the nominal price of Limpopo shares is 1 naira. So that will be 9,000 divided by 1 naira. 9,000 naira divided by 1 naira. That will give me the number of shares. Multiplied by, I don't know what the market price per share is. So I need to go and calculate the market price per share. I will go back to the question. What's the price earning ratio of Limpopo, which is 10 naira? Any per share of Limpopo is 53.30. Therefore, I will then come here, 10, price earning ratio of 10 multiplied by any per share of 53.30. That is 53.30 divided by 100 will give me 0.5330. Okay, so let's find the answer. 10 multiplied by
5.3.
5.3. Thank you. That's 5.33. Okay. Here is 5.33. So 9,000 multiplied by 5.33. We got 47,970. Here is 47,970. Then we move to the next one, which is Zambezi, denoted as Z. What's the share capital of Zambezi? According to the question, the share capital of Zambezi is 35. The nominal price per share of Zambezi is 25 kobo, because we are told that the par value of ordinary share is 25 kobo for Mississippi and Zambezi, so which is 0.25. Therefore, 35 divided by 0.25. 35 divided by 0.25 multiplied by, again, what's the price earning ratio of Limpopo? Sorry, Zambezi. The price earning ratio of Zambezi is 9. Then any per share is 38.1. 9 multiplied by 0.381. 9 multiplied by 0.381. Let me confirm that. 0.381. Yes, it is. So bring out your calculator. 9 multiplied by 0.381 equal. That's 3.429. Here is 3.429 multiplied by, I would then say 35 divided by 0.25 equal, I have 14,000 shares multiplied by 3.429 equal 48006. Here is 48006. Finally, I need to calculate for NILE. Market value of equity of NILE. Again, I will go to the balance sheet. What is the share capital of NILE? 35. Then 50 kobo nominal price for NILE. Okay, 53 divided by 0.5. Okay, here is 5,300 divided by 0.50. We multiply by, I don't know, let me calculate that. Again, the price earning ratio of NILE equal 14. Earning per share equal 32.3. 14. Here is 14 multiplied by 0.323. 0.323. 0.323 equal 14 multiplied by 0.323. 4.522. 4.522. Therefore, 5,300 divided by 0.5 equal multiplied by 4.522 equal 47,933. Here is 47,933. So I need to add up the total market value of equity for the proxy companies. So I will add up all of this. Okay. Bring out your calculator. Let's do it together. Plus 48,006 plus 47,970 plus 48 equal 191,909. 191,909. So this represents the total market value of equity of the proxy company. Now that I have the total market value of equity, I need to calculate the market value of the debts of the proxy company, which is D, debts value. Debt value of the proxy company. In the question, all the proxy companies have bank loan in their capital structure. There is no market value for bank loan because bank loan is a non-traded debt. Remember in our previous classes, I mentioned to you that there are two types of debts. We have traded debts, we also have non-traded debts. The traded debts are those fixed income securities that can be bought or sold in an organized financial market. Examples of traded debts include bank loan, debenture, as well as loan notes. Then I also said that the non-traded debts represents the securities that cannot be bought or sold, or that is not tradable or traded in an organized financial market. Examples of non-traded debts include bank loan and then overdraft. So since it is not tradable, you cannot have market value for it. So bank loan does not have market value. It means that whatever you have in your balance sheet represent the value of the bank loan. Therefore, I would then say I will add all of them together for Mississippi for all the proxy company. So D, for the proxy company, I will add the bank loan of Mississippi plus that of Limpopo plus the Zambezi, then plus the Nile. So that will give me the total, which is equal to, I will go to the balance sheets of the proxy companies. The bank loan for Mississippi is 5,300. 53 plus 12,6. Here is 53 plus 12,6 plus Zambezi. Zambezi and 9, 18,2, then 4,000. 18,2, then 4,000. 18,200 plus 4,000 equal. Let's add all of them together.
40,100.
Thank you. 40,100. Okay, so that's that. We have calculated equity value of the proxy company and the debt value of the proxy company. We'll come back later to do for Kilimanjaro when we get there. But for now, we can then go back to our formula and input the numbers there. All right? You can see for the past 10 minutes, we could not proceed with our calculation because the information we are looking for is not given in the, we don't have it directly in the question. So we need to go and estimate the numbers we are looking for. So the equity value of the proxy company is 191,909. 181,909 divided by 191,909 plus value of the debt. Debt is 40,100. What is the tax rate? Let's go to the question and check the tax rates. We are given a tax rate of 35%. In the last paragraph, we are told that corporate taxes are payable at the rate of 35%. So we are not told in this question whether the 35% is is for the proxy company or is for Kilimanjaro. Since you are not told, it is assumed that both the proxy companies and Kilimanjaro, they have the same tax rate of 35%. So I would then say 1 minus 35% will give me 65%. So we are to account for 65%. So let us bring out our calculator to do this. All right, to get our beta assets. So bring out your calculator. Let's do it together, please. I have 0.65 multiplied by 40,100 equal plus 191,909 equal. Okay, here I have where's the calculator? I have 217, yeah. 217,974. 217,974. I expected you to have given me the number instead of allowing me to be stressing myself. Huh? That's the instruction I've been issued. I should bring out your calculator and be providing the numbers. I hope I won't remind you next time. 191,909 divided by 217,974 equal, then multiply by 1.18 equal 1.04. 1.04. So the asset beta of the proxy company is 1.04. So the next thing we need to do now is to regear. Step 3. We need to regear in order to incorporate financial risk. Since debt beta is assumed to be risk-free, then the beta equity of a gear beta equity of a gear will be calculated as 1 plus 1 minus TAS multiplied by debt equity proportion equal to, sorry, I didn't put beta assets. Beta equity of a gear will be calculated as beta assets, multiplied by 1 plus 1 minus TAS multiplied by debt equity proportion. So the beta asset we just calculated is 1.04 multiplied by 1 plus 1 minus tax is 0.1 minus 0.35 will give us 0.65. Then we need the debt equity proportion. What is the debt value of the main company, which is Kilimanjaro? Remember, from step 3 up to step 5, you need the information of the proxy of the main company. From step 1 and step 2, you need the information of the proxy. So let us go to the question and pick the debt value and equity value of Kilimanjaro, which is the main company. So in this question, the debt value, the bank loan of Kilimanjaro is 17,400. 17,400 is the value of debts. So I will say 17,400 divided by, I need equity value of the proxy, sort of the main company. I need equity value. So let us go and calculate the equity value. See me the same way you calculate equity value for the proxy. Okay, Kilimanjaro. Equity value equal to, what's the share capital of Kilimanjaro? The share capital of Kilimanjaro is 4,000. What's the nominal price of Kilimanjaro? 1 naira. Okay, 1 naira is the nominal price. So 4,000 divided by 1 naira. Okay, multiply by the market price per share of Kilimanjaro. We don't have it, so we need to go and calculate it. So the price earning ratio of Kilimanjaro is 8. Earning per share is 106. So 8 multiplied by 106. 1.06. Because 106 divided by 100 will give me 1 naira 6 kobo, earning per share. So 8 multiplied by 1.06 equal 8.48. 8.48 multiplied by 4,000. 33,920. Here is 33,920. The debt value of Kilimanjaro, 17,400. 17,400. When you add the two together, this will give you 51,320. So this is total value of equity and debts of Kilimanjaro. When I want to calculate my WACC, I will need that information. So that's what I have to do it now. Therefore, I can then go back up there and put the number 33,920. Here is 33,920. So I will then bring out my calculator to say 17.4 divided by 33,920 equal, multiply by 0.65 equal, plus 1 equal, multiply by 1.04 equal 1.39. So the beta equity of a gear is 1.39. That's the gear beta of Kilimanjaro. Now that I have the gear beta, I can then go to step 4 to go and calculate my cost of equity using capital asset pricing model. KE is calculated as risk-free rate of return plus beta equity of a gear multiplied by market return minus risk-free rate. So this is the formula for calculating cost of equity. I would then say KE equal. I will go to the question, what's the risk-free rate? Remember, the risk-free rate of return is the rate of return associated with government securities. Government security like bond, like government bond, like treasury bills, and all of that. So I would then go to the question, go and identify the risk-free rate of return. So in the last paragraph of this question, you are told that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the treasury bill rate, which is currently 9% per year. The treasury bill rate of return is 9%. So corporate debt, your cost of debt is 0.5 above 9%, which means that your cost of debt is equal to 9.5%. But for now, what we are looking for is the treasury bill rate, which is the risk-free rate of return. Remember what I told you. The risk-free rate of return is the rate of return associated with government securities, like government bond or treasury bill. So we are told that treasury bill rates of return is 9%. So that's what I'm looking for. So I would then say 9 plus the beta equity of 1.39 multiplied by market return. I need market return. I will go back to the question. We are told that the market return is estimated to be 16% per year. RM is 16%. Here is 16 minus 9. Final answer. I would then say 16 minus 9, which is 7, multiplied by, excuse me, multiplied by 1.39 equal plus 9 equal 18.73.
So, please, I have a question.
What's that?
So the question said the risk-free rate is 0.5 above the treasury rate. I was thinking we are going to add 0.5 to the treasury rate to get the risk-free rate.
Read it again. Read the statement again. I'm listening. Read it again. Read now.
I'm coming, sir. Okay, it says is it please, sir? Corporate debt. So, oh, I can't find it. Okay,
You
I'm saying it says corporate debt may be assumed to be almost risk-free, and it is available to Kilimanjaro at 0.5 above the treasury bill rate, which is currently 9% per year.
Okay, that's the question. So you are told that corporate debt may be assumed to be almost risk-free rate and is available at 0.5%. Corporate debt is available at 0.5% above treasury bill rate of 9%. So KD, which is your corporate debt, is equal to 0.9 plus 9%. Sorry, 0.5% plus 9%. That's 9.5. That's your corporate debt, not treasury bill. Your treasury bill rate of return is 9%.
All right, sir. Thank you, sir.
Is it clear?
Yes, sir, it is.
All right then. So, step 5, we need to calculate WACC. This represents the the project-specific WACC. Therefore, I would then say KW equal. It is assumed that under project-specific, it is assumed that the company is financed with both equity and debt. Therefore, I will have debt value over equity plus debt, cost of equity plus debt value, equity plus debt, cost of debt, 1 minus tax. All of this multiplied by 100 over 1. So this is the formula for calculating weighted average cost of capital. Therefore, KW equal equity value. We have calculated equity value to be 33,920. Divided by the total we got is 51,320. Multiplied by cost of equity of 18.73%. Let me confirm that. Yes, 18.73%. Plus the debt value is 17,400 divided by 51,320 multiplied by cost of debt. According to the question, we are not given cost of debt. Therefore, but the examiner has told you that corporate debt may be assumed to be almost risk-free, but is available to Kilimanjaro at 0.5% above treasury bill rate of 9%. So corporate debt is equal to 0.5% plus treasury bill rate of 9%, which is 0.5 plus 9, 9.5%. So here is 9.5%. Tax rate is 35%, so we have to account for 65%. Therefore, KW equal. I'll bring up my calculator. So 33,920 divided by 51,320 equal multiplied by 18.73 equal. That's 12.38. Here is 12.38% plus 17,400 divided by 51,320 equal multiplied by 9.5 equal multiplied by 0.65 equal 2.09. Here is 2.09%. So add it up together. Here is 12.38 plus 2.09 equal 14.47 equal to 14.47%. Approximately, the project-specific WACC is 14%. That's that. Notes. KD equal to 0.5% plus 9% equal to 9.5%. So that when you're on your own, you don't struggle how we got 9.5. I just showed you now. All right. Okay, so that's for requirement number 1. Let me know if you have any question for me in this requirement number 1. If not, we move to requirement number 2.
Yes, I have a question.
Talk to me.
So how did we get 18.73 as cost of equity?
Can you see my workbook?
Yes, I can see.
Go to working number, number 4, where we have capping. Can you see the 18.73?
Okay, yes, sir.
That's our cost of equity we calculated. All right?
Thank you, sir.
You're welcome. Yes, any other question? So in the absence of no further question, we move on to requirement number 2. Let's go back to the question. Requirement number 2 is saying that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rates in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. Now, in this requirement, 2 things you are going to do. The first thing is to explain if truly corporate debt is risk-free. Then the second part of the requirement is that examiner has given to you debt beta of 0.3. You know, in the first requirement, we are not given debt beta, which of course, it means that debt beta is risk-free. But in this requirement number 2, examiner has given a debt beta of 0.3. So what that means is that we need to recalculate our project-specific cost of capital. So how do you then answer this requirement number 2? To answer the first one, which asks that corporate debt is often assumed to be risk-free, explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. So, if that is the case, what should be our response? What should be our answer to this? What you are supposed to do to answer this requirement or to answer this question is for you to juxtapose your position, whether corporate debt is risk-free or not. So to answer that, you may say, let me write it down. Number 2A. Number 2A, explanation. Explanation. So you can then say the assumption that corporate debt, the assumption that corporate debt is risk-free is not realistic because of the following. One, or A. No, I've already said A. So 1, the Kilimanjaro. Let me write that. 1, the fortress. Let me start with the fortress. Where there is the fortress, where there is default risk, that is the inability of a company to pay the annual fixed interest and the principal at maturity. Come on. I'm going to write this. Where there is a default risk, that is the inability of a company to pay the annual fixed interest and the principal at the maturity. The company or the debt holder the debt holders may forfeit the debts or the debt holder may not be able to recover the full amount of the debt. Two, companies are a legal entity distinct from its owners. Therefore, when a company liquidates, the assets will be realized and the liabilities settled from the proceeds. Any balance of the debts that cannot be covered with the proceeds will be lost. From the above, it is not a realistic assumption. Let me go back to the requirements, but I'll pick something there. Okay, it's not a realistic assumption to say corporate debt is risk-free. It is only in theory. It's only in theory and not in practice that corporate debt is risk-free. So this is how we are going to justify that explanation that says that corporate debt is often assumed to be risk-free. You know, what I'm trying to explain here is that in the first one, we talk about default risk. When you are owing somebody, say for example, you approach your bank that you need a loan, and that loan is given to you, is provided by the bank, and then you are expected to be paying annual interest on that loan. And then at the maturity date, you are supposed to pay back the principal sum. Now, because of one reason or the other, it may well be that the economic condition is not suitable for that business, and the company is now defaulting. The company now defaults to pay the annual interest. And then, of course, at the maturity dates, the company does not have the capacity to pay back the principal sum as well. So on that note, can we say corporate debt is risk-free? You borrow somebody money, the person did not pay you interest on that loan. Your principal also was not paid. So what are you going to do? The worst case is for you to arrest the person, to say, okay, you file a case against the person for court to help you recover your money, or EFCC to help you recover your money. The worst case is that when you go to court, the company will tell you, your debtor will tell you that, okay, I don't have the means now. When I have it, I will pay. You know, so you can't do more than that. So as a result, can you say corporate debt is risk-free? Risk-free means that you are going to recover your money back. That means it is risk. There is no risk attached to it. Your interest will be paid, then the principal sum will also be paid to you. So that is only when it is risk-free. But where somebody defaults to paying your interest expense, annual interest expense, and also the principal at the maturity date, in that case, you cannot say corporate debt is risk-free. Not only that, in addition, because company operate as a legal entity, that is, the owners of the business are separated from the business itself. So when the business owes money, the liability of the owners is limited to the amount they have contributed in the business. So in the event of liquidation, for example, when a company liquidates, your creditors may file a case against the company to liquidate the company. So they are going to dispose of all the assets of the company. So the proceeds from that disposal will be used to pay off the creditors. God help you that the proceeds can cover the liability. But in a situation, in most cases, when a company liquidates, in most cases, the proceeds from the disposal of the company's assets will not be sufficient to cover the debt. So in that case, if the proceeds cannot cover the debt, can we say truly that corporate debt is risk-free? No, there is a risk of loss. In this case, there's a risk of financial loss to the debt holder, because you cannot recover your full amount of the full amount that you have borrowed the company. So in that case, we cannot say corporate debt is risk-free. It is only on paper, in theory, that corporate debt is risk-free. In reality, it is not. It is not. So that's justification for that. I will then go to number 2B, whereby examiner has given us a debt beta of 0.3. All right? So I will then say 2B. So we need to recalculate. Since you have been given a debt beta of 0.3, it means that you are supposed to recalculate your discount rate. And that's what the examiner is telling you here. Calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. Okay? So let us calculate that cost of capital. Now we are given a debt beta of 0.3. Okay. Debt beta of 0.3. Let me write it out. .3. So with this debt beta of 0.3, we need to recalculate our cost of capital. Again, the proxy beta still remain the same. The same procedure is what you are going to follow. The only difference is just that now you are given a debt beta of 0.3. Therefore, I would then say the proxy beta equal to 1.18 we calculated. So we need to ungear this beta. That's step 2. Ungear. We ungear the beta to remove financial risk. So to ungear this beta, since we are given a debt beta of 0.3, therefore we are going to use the extended formula. I would then say beta assets equal to beta equity of a gear multiplied by equity value over equity value plus debt value 1 minus tax plus, because we are given a debt beta multiplied by debt value 1 minus tax divided by equity plus debt 1 minus tax. Okay, so this is the extended formula that we are going to use because we are given a debt beta of 0.3. So I would then say BA equal 1.18 multiplied by equity value of the proxy company is 191. We got 191,909. 191,909 plus debt value. The debt value we got is let me confirm, of the proxy company. The debt value of the proxy company 41. No, it's for the proxy company step 2. 4,100.
100.
Yeah. So here is 4,100. Tax rate is 35%, so we are accounting for 65%. Plus debt beta is 0.3 multiplied by 4,100 0.65 divided by 191,909 plus 4,100 multiplied by 0.65. Okay. So beta assets equal to, for the left side, I think we have done it before, to be 1.04, is it 1.39 or whatever? Let me confirm. Step 2, that's 1.04 we got before. We have done it before, 1.04. So I will say 1.04 plus the other side, which we have not gotten, is 0.65. I think I've done that one before too. Okay, 0.65 multiplied by 4,100 equal, then divide by 217. Let me confirm, is it 217? I wrote it down somewhere. Yes, 217,974. 974 equal, then multiply by 0.3 equal 0.04. Here is 0.04. When you add it to that, that will give me my beta assets is equal to 1.08. So that's for that. Then I will then go ahead and regear. Step 3 is to regear. To incorporate financial risk. So when you want to regear, because we are given debt beta, so we are going to repeat the same formula in step 2. I would then say beta assets equal beta equity of a gear, equity over equity plus debt, 1 minus tax, plus debt value, plus debt beta, debt value, 1 minus tax, equity plus debt, 1 minus tax. So you have to watch out here, even though you are using the same formula, but different variables we are going to use, because in step 3, you are supposed to use the information of the main company. Therefore, beta assets we got is 1.08. We are looking for beta equity of a gear. That's what we are looking for. Equity value of Kilimanjaro, we got 33,920. Let me go there and confirm. Equity value of Kilimanjaro, 33,920. Debt value is 17.4. This space will not be enough. Okay, I will manage it. So divide by 33,920 plus 0. Sorry, debt 17.4, 0.65 plus. Now, in this question, you have to pay attention here. If in the question you are not given debt beta of the main company, you are going to assume that it is risk-free. But we are lucky. In this question, the examiner told you that for this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. So if that is the case, I will go and put it there. 0.3 multiplied by debt value is 17,400. We are accounting for 65. 33,920 plus 17.4 multiplied by 0.65. At times, the tax rates for the proxy company and the main company may be different, so you have to be careful. So with this, I will then bring out my calculator, doing one after the other. So 0.65 multiplied by 17,400 equal plus 33,920 equal. Here I have 45. Let me write it down somewhere. 45,230. That is for the denominator on the first one. Therefore, I would then say 33,920 divide by 45,230 equal 0.75. So here is 1.08 equal to 0.75 BEG plus the other side So for the other side, I have okay, 17,400 multiplied by 0.65 equal 11,310 divided by 45 to 30 equal multiplied by 0.3 equal 0.075. Here is 0.075. Okay, so collect like terms. To collect like terms, I would then say BEG equal to 1.08 minus 0.075 all divided by 0.75. Final answer. So 1.08 minus 0.075 equal divided by 0.75 equal. Okay, I got 1.34. Here is beta equity of a gear is 1.34. So at this point, I need to calculate my work. Let me use, since I don't have sufficient space, so let me remove all the workings. I'll push this one down. All right, working. Now, step number 5 is for me to calculate. So I still need more space. Okay, let's go down there and put it and continue. So I'll continue from here. So step number 4. Let me draw a line to show. Okay. Let me see. So it indicates the continuation, not the working. Okay, so step 4 is to calculate cost of equity, which is capping. So cost of equity equal to the risk-free rate of return of 9% plus the beta equity of a gear that we just calculated, 1.34. 1.34. Market risk premium is 7%. That's it, the difference between 16% minus 9%. So bring out your calculator. 1.34 multiplied by 7 equal plus 9 equal 18.38. So our cost of equity equal to 18.38%. Finally, step 5, we need to calculate the work. So K, W equal, I don't need to write our formula again. I've written our formula before. Equity value of Kilimanjaro is 33,920 over total value 51,320. Cost of equity of Kilimanjaro is 18.38% plus debt value of Kilimanjaro 17,400, total value 51,320. Cost of debt is 9.5%. Tax is 65.35. We're accounting for 65. So bring out your calculator. Multiply by 33,920 equal. Divide by 51,320 equal 12.15. PW equal to 12.15% plus the other side. Which is 17,400. Excuse me. 17,400 divided by 51,320 equal, multiply by 9.5, multiply by 0.65. Equal. Let me calculate that. 17,400 divided by 51,320 equal. Then multiply by 0.95. So multiply by 9.5 equal. Multiply by 0.65 equal 2.09. Here is 2.09%. So add it up. So that will give me 14.24. 14.24%. So when you look at the difference between the cost of capital we calculated where there was no debt beta, in that one we got, I think we got 14.47. We got 14.47. Now that we have debt beta, that's reduced to 14.2. 14.24. So that's about marginal difference of 23.23. Yeah. So it's marginally lower by 23%. So this is what the examiner wants you to do. So yeah. Let me see. Do you have any question for me so far? Any question for me? Debbie, Believe, Fidelis, all of you, you have not been providing me numbers. You are not following instruction. It's okay.
So we've been providing number before we want to pronounce or call. You're already given the answer.
Yeah, I
So
mean,
it
how
comes-
could I be fast? I shouldn't be faster than you do now. Eh? You should have
You
the
know, but
magic kind.
so we are writing at the same time.
It's okay, no worries. So I just
Yes.
want you guys to participate. That's why I asked you to give me numbers. All right then. So in the absence of no further question, let's go to the number 3 requirements so that we can move to WACOCA, and that will be all on cost of capital. So in that number 3 requirements, examiner is asking you to discuss whether systematic risk is the only risk that Kilimanjaro's shareholder should be concerned with. So first thing first, before you will be able to answer that question, you must understand what is systematic risk, what is unsystematic risk. When we get to portfolio theory, by the grace of God, in our subsequent classes, we are going to discuss about, in details, we are going to discuss about systematic risk as well as the unsystematic risk. But just to brief you, examiner is asking you in this question whether the shareholders of Kilimanjaro should only be concerned with systematic risk. Remember earlier when I was explaining what project-specific cost of capital is all about, I said that a company must estimate a cost of capital that is consistent or that will be consistent with the risk associated with the project. When you said risk, we have business risk, we also have financial risk. So in this case, examiner is asking you whether the shareholders of Kilimanjaro should be concerned with only systematic risk. No. For you to answer the question, the first thing first you need to do is to explain what systematic risk is all about. A systematic risk is a kind of risk that affects every company in the economy, like the one that happened in 2020 during COVID-19, whereby every companies in the world were affected by COVID-19. That's the kind of risk we are talking about. Within an economy, when there is inflation risk, everybody will bear the consequence. Within an economy where there is an increase in interest rates, that means that will also affect producers or investors. If the interest rate increases, the burden will be shifted to the final consumers because the manufacturers will go elsewhere to relieve the burden. And that's why the burden will be shifted to the final consumers. So whenever there is a systematic, when you say systematic risk, it's a kind of risk that affects every individual or every individual companies in our economy. It is not diversifiable. It is general, and it is market imposed. So as a result, to answer this question, after your definition of what systematic risk is all about, you then say that the shareholders of Kilimanjaro PLC should be concerned with the total risk that affects the project. Total risk is the systematic risk and then the unsystematic risk. When you combine the two together, that will give the total risk that affects the company and the project. All right. So the shareholders of Kilimanjaro PLC should be concerned with the total risk that affects the business. Okay. Then of course that will be after you have explained what systematic risk is all about. So that is that as per our project-specific cost of capital. By the grace of God, when we get to capital budgeting, we are going to do more illustrations. We are going to do a bigger illustration than this under capital budgeting, because in 2014, it was tested. Requirement number A, you are asked to calculate cost of capital, appropriate cost of capital. I think that the mark awarded was 7 marks. Then in number B part of that question, students were asked to evaluate the project using NPV, right? So in 2017 again, it was tested. Number A, that is the question you have in Ferrari PLC. So students were asked to calculate appropriate cost of capital, 5 marks. Then number B, you are asked to evaluate the projects using net present value. Okay. Then I think in 2021 or 2022, I can't remember clearly, under valuation, students were also asked in the A part to calculate cost of capital, 14 marks. Then number B, determine the value of the business. So as we proceed, when we get to capital budgeting under illustrations, we are going to test all those questions that I talk about so that holistically we'll be able to complete start from the start to the finish of those illustrations. But for now, just have the understanding of how to calculate project-specific cost of capital and especially the procedures, the underlying procedures. All right. So finally, under cost of capital, let's talk about weighted average cost of capital of the combined activities. Let's talk about WACOCA.
Excuse me, sir.
Yes,
Sir, please, you said total risk is made up of systematic risk and what?
and unsystematic risk.
Okay. Thank you, sir.
You're welcome. So let's talk about weighted average cost of capital of the combined activities. I call it WACOCA. You remember, I will explain again. When we started this topic, I gave it to you that there are 3 ways you can calculate weighted average cost of capital. Examiner can ask you to calculate traditional weighted average cost of capital, whereby you use the capital structural information of the company. Then 2, the one we just completed, is our project-specific cost of capital, which is calculated when a company is diversifying or debt equity proportion are expected to change significantly as a result of undertaking a project. The third cost of capital is the weighted average cost of capital of the combined activities. So the weighted average cost of capital of the combined activity is calculated when a company is engaged in several business activities almost at the same time. I repeat, the weighted average cost of capital of the combined activities is calculated when a company is engaged in different activities at the same time. For example, Network PLC or Network Limited is a business in education industry. At the same time, Network may be engaged in communication business or oil and gas or possibly real estate. So when a company is engaged in several activities at the same time, then instead of using different cost of capital to appraise projects in each of the business activity, then there is need for the company to estimate a cost of capital that will be suitable for appraising projects in each of those activities. So, for your purpose, for your understanding purpose, I will say, let me say, WACOCA is calculated when a company is engaged in different activities, in different business activities at the same time. When instead of appraising projects, in each activity using different WACC, a cost of capital that will be suitable to evaluate projects in each activity we need to be estimated. This cost of capital is called WACOCA. Okay. The following procedures in the calculation of WACOCA, the following procedures should be undertaken. So when you want to calculate WACOCA, there are 7 procedures that you need to undertake. The first procedure steps involved in calculating WACOCA. Step number 1, you are going to identify the beta of each activity. Identify the beta of each activity. Step 2, ungear the beta if geared. Step 3, calculate market value of equity and debt of each activity. Okay. Step 4, calculate beta assets or asset beta. Calculate asset beta of the combined. Asset beta of the combined businesses. That is the BAC. Asset beta of the combined businesses. Step 5. Now, in that step 4, how do you calculate your asset beta of the combined businesses? Let me use it. BAC. So to get your beta asset of the combined businesses, I would then say BAC equal to beta asset. Let's say, for example, we have only 2 activities, 2 different business activities. Therefore, I will look for the beta asset I've calculated in step 2 of activity 1, multiply by total market value of equity and debts of activity 1, divided by total market value of equity and debt of activity 1 and 2 on one side, plus, open a bracket, beta assets of activity 2 multiplied by total market value of equity and debts of activity 2 divided by total market value of equity and debt of activity 1 and 2. So this is the formula we are going to use to calculate the combined asset beta. Once this is done, I will then move to step 5. Step 5 is to regear. Step 6 is to calculate CAPIMS. Then step 7 is to calculate WACOCA. So these are the 7 procedures you are going to embark upon whenever you want to calculate WACOCA. I did not give you formulas for step 2, step 3, step 5, 6, and 7 because it's something we have done. So it's the same formula. And then that's what I ignored it. However, when you look at the material you have, you see the formula there as well. So at this point, we can then proceed to solve an illustration to demonstrate how to calculate weighted average cost of capital of the combined activities. All right. So I will stop sharing this. Let's move to the material. I want to share the material with you. I believe you can see my screen. So go to illustration number 16 in the material, illustration number 16, Columbia PLC. Are we together? Are we on the same page?
Yes, sir.
All right then. Columbia PLC provides training and financial services. The training service accounts for 2/3 of the value of the company. The company has a total debt to total market value ratio of 30%. The average beta and debt to total market value for the financial service sector are 0.9 and 25%. The average beta and debt to total market value for the training service sector are 1.5%, are 1.5 and 12%. Other information includes 1. The equity risk premium is 3.5%, and the rate of return on short-dated government stock is 4.5%. 2. Columbia PLC can borrow at 2.5% above the risk-free rates. 3. Corporation tax is 40% on taxable profits. 4. Assume that debt is risk-free. You are required to estimate the cost of equity capital and weighted average cost of capital for Columbia PLC. So examiner wants you to calculate cost of equity and then WACC for Columbia PLC. First thing first is that you need to ask yourself, what kind of cost of capital do I want to calculate? So is it traditional WACC? Is it project-specific WACC? Is it WACC of the combined activity? I've explained to you on the 3 of them what you need to do. You can only calculate weighted average cost of capital of the combined activity if the company is engaged in different activities at the same time. You can only calculate WACC using project-specific if the company is diversifying or debt equity proportion are expected to change as a result of undertaking the project. Then you can only calculate traditional WACC if in the question you are given capital structural information, you are given equity capital, preference share capital, debt capital. You are also given the return of each of those sources of finance, like dividend and the interest. So in this question, examiner has told you in the first paragraph that Columbia PLC provides training and financial services. So what this means is that since Columbia is into training as well as the financial services, it means that we are supposed to calculate weighted average cost of capital of the combined activity. So that will now take us to the working notes so that we can quickly solve it before our time elapsed for today. I'll stop sharing this, then I will share the working note with you. Okay. Let me see. All right. So, to solve this question, the name of the company is Columbia PLC. Columbia PLC. Examiner is asking us to calculate cost of equity capital and weighted average cost of capital for the company. Okay. So I would then say calculating cost of capital. To get the cost of equity, what you're supposed to calculate is the capital pricing model based on the information given. Therefore, because Columbia PLC is into training and financial services, it means that we are supposed to calculate WACOCA, weighted average cost of capital of the combined activity. So the first step that you are going to carry out is for you to identify the beta of each activities. I would then say beta of activity. What are the activities in this question for Columbia? We have training, C. Then we also have financial services. Financial, F. Therefore, I will then go back to the question, what is the beta of training services? Let's go there and pick the information we are looking for. Examiner told you in the second paragraph that the average beta and debt to total market value for financial service sector are 0.9 and 2.5. So the beta, the average beta of financial service is 0.9. The average beta of training service is 1.5. So let's go and put it there. Here is 1.5. Here is 0.9. So the next thing I need to do now is to ungear. If this 1.5 and 0.9 are geared, so I will only put down ungear if I'm told in the question that training and financial service has debts. Our focus is on each of the activities, not on the company in this step 1 and 2. In fact, in step 1 up to step 4, our focus is on each of the activity, not on the company as a whole. Therefore, I want to know if the beta of training of 1.5 and beta of financial services of 0.9 are geared. So if in the question I'm given debts for training and debt for financial service, it means that the 1.5 and 0.9 are geared. So I will go back to the question. From the same paragraph 2 and 3, examiner has told me that the debt to total market value, of financial service is 25. So if debt is 25, it means equity is equal to 75 for financial service. For training service, if debt to total market value is 12%, it means equity is equal to 88%. This is what I'm saying. In this question, examiner has given me debt to equity ratio. Debt to equity ratio of training. Examiner told me that for training, debt is equal to 12%. It means that equity will be equal to 88. For financial service, examiner told me that debt equity ratio is equal to 25. Debt is 25. then it means that equity will be equal to 75. That's the implication. So when you talk about debt equity ratio, it simply means the gearing ratio. What is the extent at which the company is exposed to financial risk? All right. So if that is the case, because the examiner has given me debts for each of the activities, it means that the beta of 1.5 and 0.9 are geared. So in this case, I need to go ahead and ungear it. Therefore, I would then say beta assets equal to beta equity of a gear multiplied by equity value divided by equity plus debt 1 minus tax. I will go back to the question. I need to go and check if I'm given debt beta. If I'm given debt beta, it means I have to use the extended formula. When you look at note number 4 in the question, you will see that you have to assume that debt is risk-free. So since debt is risk-free, so I don't need to use the extended formula. So this is the formula we are going to use. So in that case, I would then say beta assets equal to beta equity of a gear. In this case, I want to calculate for training. Training, beta asset of the training. Or let me rewrite this. Beta asset of training equal to the beta asset of that training is 1.5 into equity value of training. Since debt is 12% for training, let me confirm that again. Is this training that is 12? Yes. Training is, yes, training is 12, then equity is 88. So in this case, since debt value is 12% for training services, then equity will be equal to 88. Therefore, I would then say 88 divided by 88 plus debt of 12. What's the tax rate? We are given corporation tax of 40% multiplied by 0.6 equal for training. I'll bring up my calculator to say 0.6 multiplied by 12 equal plus 88 equal 95.2. So 88 divided by 95.2 equal multiplied by 1.5 equal 1.39. Here is 1.39. So that's the beta asset of training. I need to calculate beta asset of financial service equal 0.9 into the debt equity proportion of financial service is 25 to 75. So equity is 75. E is 75 over 75 plus D, 25. Tax rate is 40%. We are accounting for 60%. What do we get? Bring out your calculator. Let's do it together. 0.6 multiplied by 25 equal plus 75 equal 90. So 75 divided by 90 equal multiplied by 0.9 equal 0.75. Here is 0.75. So we have ungeared. So we are going to step 3. Step 3 says calculate market value. See, we are following a format. Step 3 says calculate market value of equity and debt of each activity. That is market value of equity and debt of training and financial service. According to the question, let's go to the question. We say market value let's go back to the question. We are told that from the first paragraph, examiner told us that the training service account for 2/3 of the value of the company. If training service account for 2/3, it means financial service will account for 1/3. So examiner has made life so easy for us by giving us the market value. So I will say training equal to 2/3, financial service market value equal to 1/3. The essence of calculating market value is to determine the weight which you are going to use to calculate your beta asset of the combined. Because you can see in this our solution, we have different asset beta, 1.39 and 0.75. You need only one. When you want to regear, you need only one beta. Since you have beta of different beta for each activity, you need to calculate the beta asset of the combined. And to get that beta asset of the combined, you need to calculate the market value of equity and debt of each of the activities. So you are going to use that market value of each of the activity to form the proportion of each beta so that we can get only one beta. So that will now take us to step 4. Step 4 says we should calculate. Step 4 says we should calculate beta asset of the combined. I would then say calculate. Don't let me just, you can just ignore calculate. I can say beta assets of training, or say simply say beta assets. Sorry, I wrote it twice. Beta assets of the combined. BAC. Therefore, BAC will be calculated as the beta asset of the combined will be calculated as beta assets of training multiplied by, in the formula I use 1 and 2. 1 for activity 1, then 2 for activity 2. Now that since examiner has given us the name of each of the activities, so there is no need for me to use 1 and 2. I have to use the code for each of the activity, which is training and financial. So multiply by total market value of training divided by total market value of equity and debt of training and financial. Plus beta asset of financial multiplied by total market value of financial divided by total market value of training and financial. Okay. Beta assets of the combined will then be equal to the beta assets of training that we calculated in step 2 is 1.39. We got 1.39 for training. So I would then say 1.39 multiplied by total market value of equity and debt of training. Examiner has told us in step 3 that market value of equity and debt of training is 2/3. So I would then say 2/3. 2 divided by 3 plus beta assets of financial, we got 0.75. Here is 0.75 multiplied by total market value of equity and debts of financial, which is 1/3. Therefore, I'll bring out my calculator. The beta asset of the combined will then be equal to 2/3 2 divided by 3 multiplied by 1.39 equal 0.93. Here is 0.93 plus the other side 0.75 divided by 3, 0.25. So 0.93 plus 0.25 equal 1.18. So the beta assets of the combined equal to 1.18. So that's it. This is we just achieved step number 4. So we're moving to step 5. Remember, the essence of calculating step 3, which is market value, is for you to be able to form the proportion of each of the activities in getting the beta asset of the combined. And that's what we have done so far. Step 5 is to regear. We need to regear to incorporate financial risk of the company, which is Columbia PLC. Since debt beta is risk-free, then to regear, I would then say beta equity of a gear equal to beta asset of the combined multiplied by 1 plus 1 minus tax debt equity proportion of the company. Okay, so beta equity of a gear will then be equal to our beta asset of the combined is 1.18. We got there in step 4. Multiplied by 1 plus the tax rate given in the question, I think, is 40%. Yes, we are given corporation tax of 40%. So we have to account for 60%, 0.60. Now, we need the debt equity ratio of Columbia PLC. I will then go back to the question. What is the debt equity ratio of Columbia PLC? In the first paragraph, examiner told you that the company has a total debt to total market value ratio of 30%. Total debt to total market value ratio, meaning that the debt equity ratio of the company is 30%. Debt is 30%, then equity will be 70%. So DE ratio of this company, let me just put it here. Debt equity ratio of the company is equal to debt is 30, then equity will be 70. So here will be 30 divided by 70. So final answer. My BEG will then be equal to, bring out your calculator to do that. 30 over 70 equal multiply by 0.6 equal plus 1 equal multiply by 1.18 equal, that's 1.48. Beta equity of a gear is 1.48. I will then go to step 6. Step 6 says calculate cost of equity, and that's one of the things examiner asks you to calculate. We're asked to calculate cost of equity using capping. Cost of equity capital using capping. KE. Therefore, KE equal to risk-free rate of return plus the beta into market return minus risk-free rate. All right. So KE, cost of equity equal. I will go back to the question. What is risk-free rate of return? In the other information number 1, you are told that the equity risk premium is 3.5 and the rate of return on the short-dated government stock is 4.5%. The rate of return on short-dated government stock is 4.5. That 4.5% is the risk-free rate. Remember, the risk-free rate of return is the rate of return on government securities like treasury bill, like government bond. So examiner has given you short-dated government stock to be 4.5%. So that's the risk-free rate of return, 4.5. So here is 4.5 plus the beta of 1.48 we got in step 5 multiplied by market return. Let's go and determine market return in the question. According to the question, you are told that in note 1, the equity risk premium is 3.5%. The difference between market return and risk-free rate of return represents risk premium. So which is 4.5? Is it 4.5 or 3.5? 3.5, yeah. Let me explain again. RM, let me put it there. RM equal to market return. RF equal to risk-free rate of return. So the difference between market return and the risk-free rate of return is called market risk premium. Market risk premium. So in this question, examiner has already, you are not given market return, but the examiner has already given you the difference between market return and the risk-free rate of return, which is 3.5%. So therefore, our cost of equity will then be equal to, bring out your calculator again, 3.5 multiplied by 1.48 equal plus 4.5 equal 9.68. So the cost of equity is 9.68%. Finally, I need to calculate WACC. We want to calculate WACOCA. So K, W, equity over equity plus debts multiplied by cost of equity plus debt value, equity plus debts, cost of debts, 1 minus tax. All of that multiplied by 100 over 1. So this is our WACOCA. I would then say KW equal equity value. Examiner has told us in the question that debt is 70, then equity is 70%. So here will be 70 divided by 100. There's no need for you to be doing 70 over 100 on the day of your exam. Just simply put 0.7 multiplied by cost of equity of, what did we get in step 6? We got 9.68 multiplied by 9.68% plus debt value is 30%. So 30 divided by 100 multiplied by cost of debt. Let's go back to the question. The cost of borrowing. We are told that number 2, in note number 2, you are told that Columbia PLC can borrow at 2.5% above the risk-free rates of return. The risk-free rate of return is 4.5%. 2.5% above 4.5 is 7%. Therefore, cost of debt is 7%. Here is 7%. Tax is 40%, so we are accounting for 60 So KW equal, I will then say from my calculator, 9.68 multiplied by 0.7 equal 6.78. 6.78% plus 0.3 multiplied by 7 multiplied by 0.6 equal 1.26. When you add it together, your WACOCA is equal to plus 6.78 equal 8.04. That's it. That's what examiner is asking you. Note, let me write it there. Note, KD equal to, we are told is cost of debt is 2.5% above risk-free rate plus 4.5. Risk-free rate of return is 4.5. So our KD is equal to 7%. Don't go and do this on the day of your exam. Don't go and be writing this on your answer booklets. Just for the purpose of this class, so that you understand how we got the 7%. That's why I have to rewrite it out. Okay then, so this is how to calculate weighted average cost of capital. Again, as we proceed, particularly under capital budgeting, we are going to do another calculation that relates to WACOCA. So watch out. So this will be the end of cost of capital, which we started on January 10th. So today is January 31st. So we just ended the cost of capital. So that's that. Let me hear from you, please. If you have any question for me before we call it a day. Yes, I would like to hear from you. Any question for me? Believe, Debbie, Prosper, Zainab. Who is user? What's the name of the user? User, what's your real name?
Fidelis.
Fidelis. Fidelis, why are you changing? you okay? Yeah, Wilson, how are you? All right then. So that's that. If you don't have any question for me, we have to call it a day. I'll give you a few seconds to respond in case you have any question for me. Any question? So in the absence of no question, this is where we are going to draw the curtain for today. By the grace of God, we are meeting again next week, Wednesday, by the grace of God. And then again, Mr. Shuaju will be having on Friday on the strategic financial management. Thank you guys for your time and understanding. See you next time by the grace of God. Good night.
Thank you, sir.
Thank you so much, sir.
You're welcome.